Asian guy here. Something just shifted in Washington, and the market didn't see it coming. I'm not talking about a tweet. I'm not talking about a policy announcement. I'm talking about a fundamental change in how power operates in this country. And if you don't understand what just happened in the last 72 hours, you're about to get blindsided by the biggest economic recalibration since the Plaza Accord. Because what they're calling Trump's short-term strategy isn't short-term at all. It's a demolition. Let me walk you through what the surface looks like. The headlines are talking about market volatility. They're talking about investor uncertainty. They're using words like unpredictable and erratic and destabilizing. The S&P dropped 3% in a single session. Bond yields spiked. Currency traders are scrambling. The talking heads on CNBC are doing that thing where they pretend to be calm while their eyes scream panic. And the official narrative is simple. Trump announced a series of executive actions. Tariffs on steel, restrictions on critical mineral exports, emergency powers invoked under the Defense Production Act. The market reacted badly. That's the story they want you to believe. But here's what they're not telling you. This wasn't a reaction. This was a trigger. And the people who designed this move knew exactly what would happen. They knew the market would convulse. They knew hedge funds would liquidate positions. They knew foreign central banks would start making phone calls. They knew all of it. And they did it anyway. Which means the volatility isn't the mistake. The volatility is the point. Let me show you something that doesn't make sense. When Trump invoked emergency powers to restrict rare earth exports, the immediate response was predictable. Tech stocks fell. EV manufacturers panicked. Supply chain analysts started writing obituaries for the green energy transition. But if you look closer, something else happened. Something quiet. Within 18 hours of that announcement, 3 separate commodity trading firms based in Singapore and Dubai started accumulating physical reserves of gallium and germanium. Not futures, not paper contracts, physical metal. They moved fast, they moved silent, and they moved like they knew this was coming. Now, why would traders on the other side of the world react that quickly to a policy decision that hadn't even been fully implemented yet? Why would they bypass the futures market entirely and go straight to physical delivery? Because someone told them. Someone with access to the decision before it became public gave them the roadmap. And that's not speculation. That's logistics. You don't secure that much physical material in 18 hours unless you've already lined up the suppliers, negotiated the contracts, and arranged the transport. This was premeditated. This was coordinated. And it suggests that what we're watching isn't chaos. It's choreography. Here's where it gets darker. The short-term strategy label is deliberate misdirection. They're framing this as impulsive, as reactive, as Trump being Trump. But when you map out the sequence of moves, it tells a different story. First, the tariffs. That forces a supply chain bottleneck. Then, the export restrictions. That creates scarcity in critical materials. Then, the emergency powers. That gives the executive branch unilateral control over industrial production. Each move builds on the last. Each move tightens the noose. And the end result is a scenario where the U.S. government can effectively dictate terms to any industry that relies on materials now classified as strategically essential. Think about what that means. If you're a solar panel manufacturer, you need gallium. If you're building semiconductors, you need rare earths. If you're producing EV batteries, you need lithium processing that depends on chemicals now under federal oversight. And if the government decides you're not aligned with national priorities, they can cut off your supply. Not through legislation, not through Congress, through executive order. That's not short-term tactics. That's structural control. And it's happening right now while everyone is distracted by the stock market noise. But here's the part that should terrify you. This only works if the pain is widespread. If the market crashes and only a few sectors get hurt, people ask questions. But if everyone bleeds, if portfolios across the board take a hit, then it just looks like volatility. It looks like the cost of doing business in uncertain times. And while everyone is focused on their losses, on their 401ks shrinking, on their retirement plans getting shredded, the real consolidation happens in the shadows. The firms that were tipped off early, the ones that repositioned before the announcement, they're not bleeding, they're buying. They're accumulating assets at a discount while everyone else is panic selling. And who benefits from that? Follow the money. Look at who sits on the advisory boards. Look at who has private equity stakes in the commodity firms that just went on a buying spree. Look at the overlapping board members between defense contractors and rare earth mining operations. This isn't about Trump's personality. This isn't about his style. This is about a network of interests that saw an opportunity to use executive power as a crowbar to pry open markets that were previously inaccessible. And they're using the spectacle of political chaos as cover. Let me show you how deep this goes. 3 weeks before the announcement, there was a quiet meeting in Colorado. Nobody covered it. No press releases, no leaked memos. But if you track private jet registrations, you'll find something interesting. Executives from 4 different mining companies, 2 former cabinet officials, a handful of defense industry consultants, all in the same city, all on the same weekend. And then 3 weeks later, the executive order drops, and suddenly those same mining companies are sitting on deposits that just became strategically critical. Coincidence or coordination? And here's what makes this so insidious. The public narrative is about national security, about protecting American interests, about ensuring that China doesn't dominate the supply chains of the future. And sure, there's truth in that framing. China does control a disproportionate share of rare earth processing. That is a vulnerability. But the solution being implemented doesn't distribute power. It doesn't decentralize supply chains. It just shifts the choke point from Beijing to a boardroom in Denver. Same control, different logo, and the American public is supposed to cheer because at least it's our oligarchs this time. Now let's talk about what the Fed is doing, or more accurately, what the Fed isn't doing. When the market started hemorrhaging, the expectation was intervention, rate cuts, liquidity injections, emergency stabilization measures, but the Fed stayed quiet. Powell released a statement that basically said, "We're monitoring the situation. No action, no signal. Just wait and see." And that's bizarre because the Fed has spent the last 15 years intervening at the first sign of turbulence. But now, when the market is screaming for a floor, they're letting it fall. Why? Because they were told to. Because this contraction is part of the plan. Think about what the Fed's silence actually communicates. It tells the institutional players that there's no safety net this time. It tells the algorithmic trading systems that the usual circuit breakers aren't coming. And most importantly, it tells the people who engineered this move that they have a clear runway. The Fed isn't going to step in and stop the transfer. They're not going to stabilize prices before the consolidation is complete. And that silence is worth more than any statement they could release. Because it means the smart money knows exactly how long they have to operate before the intervention arrives. And they're using every second of it. But here's the deeper layer. The Fed's inaction isn't just about this specific moment. It's about resetting expectations. For over a decade, markets have operated under the assumption that central banks will always intervene, that there's always a floor, always a bailout, always a way to prevent systemic collapse. But what if that assumption is being deliberately broken? What if the message is, you're on your own now, figure it out? Because once that expectation is shattered, once market participants realize they can't count on the Fed to save them, behavior changes, risk appetite changes, and capital flows in very different directions. It flows toward the entities that have direct access to physical assets, to hard commodities, to supply chains that can't be printed or inflated away. If you crash the market, you shake out weak hands, retail investors, pension funds, foreign capital. They sell into the panic. And who's on the other side of those trades? The entities that knew this was coming. The firms with cash reserves sitting on the sidelines waiting for exactly this moment. It's a transfer mechanism. Wealth doesn't disappear in a crash. It changes hands. And right now it's moving from the people who believed the market was stable to the people who engineered the instability. And here's the mathematical reality they don't want you to calculate. When asset prices drop 30%, it doesn't mean the economy lost 30% of its value. It means someone bought at 30% off. The value didn't vanish, it relocated. And in a controlled crash, in a strategic demolition, the buyers aren't random. They're pre-selected. They're the ones with dry powder, with credit lines already negotiated, with acquisition teams already assembled. They're not reacting to the crash. They triggered it. And now they're executing the second phase of a plan that was written months ago. Look at the pattern. Every major crisis in the last 20 years has ended with greater consolidation. The 2008 financial collapse, the big banks got bigger, the COVID crash, tech monopolies expanded their reach, the supply chain disruptions, mega logistics firms absorbed their competitors. Now this, the short-term strategy that isn't short-term at all. It's the same playbook. Create chaos, let the weak collapse, absorb the wreckage, emerge stronger and more concentrated than before. Except this time, the chaos isn't a bug in the system, it's a feature. It's the designed outcome. Here's the thing that nobody wants to say out loud. This strategy doesn't care about you. It doesn't care about your portfolio. It doesn't care about economic growth or job creation or any of the talking points they'll use to justify it later. What it cares about is consolidation. It cares about bringing critical supply chains under centralized control. It cares about positioning the United States, or more specifically, a very small circle of interests within the United States, as the gatekeeper to the materials that power the next century of technology. And if your savings get vaporized in the process, that's acceptable collateral damage. Let me give you a scenario. It's 6 months from now. The tariffs are entrenched. The export bans are normalized. The emergency powers are still in effect because the crisis never technically ended. Supply chains have reorganized around the new reality. And the firms that control access to those supply chains are posting record profits. Not because they innovated, not because they built something better, but because they were in the room when the plan was drafted. They knew where to position themselves before the starting gun fired, and now they're extracting rent from an economy that has no choice but to pay. Meanwhile, the media will have moved on. They'll be covering the next scandal, the next outrage, the next tweet, and the structural shift that happened during this window of chaos will be invisible to most people. It'll just be the new normal. Prices will be higher, options will be fewer, and the explanation will be something vague about market forces and geopolitical realities. Nobody will connect it back to this moment. Nobody will trace the line from the executive orders to the commodity accumulation, to the silent Fed, to the consolidated control. It'll just be accepted as the way things are now. But you're watching it happen in real time. You're seeing the mechanism in motion, and once you see it, you can't unsee it. The short-term strategy label is a lie. This is long-term infrastructure. This is the reordering of economic power dressed up as impulsive decision-making. And the people who designed it are counting on you to believe the performance instead of reading the script. So what does this mean for the markets going forward? It means the volatility isn't over. It means every announcement, every executive order, every emergency declaration is another opportunity to shake the tree. And every time the tree gets shaken, assets change hands, wealth concentrates, control tightens. The crash isn't the end game, the crash is the entry point. And the entities that are positioned to buy at the bottom aren't guessing, they're not hoping, they know, because they built the bottom. And here's the cruelest part. When the market eventually stabilizes, when the dust settles and the indexes recover, it'll be framed as resilience, as proof that the system works, as evidence that American capitalism can withstand shocks and come back stronger. But what actually happened is that the system was hijacked, it was weaponized, and the people who lost everything in the process will be told they just didn't have the stomach for volatility. They'll be blamed for panicking, for selling low, for not having the conviction to hold through the storm, when the truth is they never had a chance. The game was rigged before the bell rang. So pay attention. Watch who accumulates during the panic. Watch which firms announce major acquisitions in the next 90 days. Watch which industries suddenly find themselves dependent on supply chains controlled by a very small number of gatekeepers. Because that's the tell. That's the proof that this wasn't short-term at all. This was the opening move in a consolidation play that's been in development for years, and it's just getting started. The markets are still reacting. The headlines are still spinning. And somewhere in a boardroom that you'll never see, decisions are being made about which sectors collapse next, about which commodities get restricted, about which industries get starved and which ones get fed. And none of it will look like a plan. It'll look like chaos. It'll look like the unpredictable consequences of an unpredictable leader. But chaos is just order that you're not supposed to recognize. Stay alert.